All right, my friend, so Scott emailed me. He said, hey, Josh, can you share the pros and cons of cash value life insurance? It's a good question, one I've talked about before, but I certainly want to talk about it again because I think it's important to understand. A lot of people, I just did a poll. I said, are people interested at all in learning more about life insurance? And like 89, 90% of the people said no. But the issue is that I think there's a lot of ignorance, frankly, on how life insurance works. I really, really do. I think life insurance can be a wonderful strategy. Unfortunately, kind of like the Christian church is its own worst enemy, with advocating the Christianity. Life insurance, the industry is its own worst enemy in advocating for life insurance. And so because of that, we have many, many, many examples of life insurance agents that are just freaking idiotic at best. And so, of course, then you come across some of these guys and you discount the whole thing. Like, yep, life insurance is bad because I've talked to so many life insurance agents that were just idiotic. So let me share with you what, well, let's start with the idea of buy term and invest the rest, which is something that most people understand, and I actually subscribe to this theory. The theory is life insurance will give you a subpar performance relative to the markets historically and most likely in the future. So if you're buying life insurance as an investment, you're going to get a subpar performance. You're not going to get as much money as you would if you just bought the investment by itself. And inherently makes sense because life insurance has significant cost to it for sure because it's life insurance. So the idea would be, well, if you need the life insurance, just buy a term policy because it's incredibly cheap. And then the money you save from buying the term policy as opposed to a cash value policy, you can invest in an index fund. And that way you're getting the life insurance coverage because of the term, and you're able to get the full efficiency of the markets with your index funds, so thus buy term and invest the rest. And I actually agree with that 100%. I mean, and there's no two ways around that. That theory is practical application really makes sense. Now, I will share with you, and I always felt that way until I came across this guy in probably 2012, I think. A guy living in the Virgin Islands. He was a big executive in New York City, so he had bought a life insurance policy with a firm I was affiliated with back in the middle 80s. And it was based like a deferred compensation plan, an executive deferred compensation plan. So I think his company paid $100,000 for 10 years into this universal life insurance policy. And I think it was like 84 or something like that when he started it. But anyway, so it just happened to coincide with wonderful interest rates that had a guaranteed minimum of I think it was 5.25 was a guaranteed minimum of the cash value. And if you had a certain amount of cash value above a certain threshold, it gave you cash value up to 5.85%. All right, so in this case, when he was young and making good money, the company gave, again, put this $100,000 into a deferred compensation plan that funded a life insurance component that was paying nothing like the stock market, but it's paying good. And so we fast forward until 2012, 13, 14. He had basically, at that point, like $6 million, something like that, of life insurance. All right, so it was completely paid up. He had to pay no more premium at all on a $6 million death benefit, and that death benefit was growing each and every year because he had about $5 million or something like that of cash value, maybe $4 million, but a significant amount of money in cash value. And because he had breached this threshold that the insurance company gave him, was providing him 5.85% guaranteed minimum cash value increase each and every year, guaranteed minimum of 5.85%. So in this case, the guy was making $58,000 per $1 million of cash value. So he's making like $250,000, $300,000 a year in cash value increase, completely tax-free. It was insane. And because he was a high-paid executive, he had significant income too from pensions, 401k distributions, whatnot. And so he was in a 25-30% tax bracket or whatever it was. And so his tax equivalent yield was like 9%, guaranteed by one of the most solid insurance companies out there. No risk at all. It was just freaking, it was incredible. It was incredible. So the idea that life insurance is always evil, no, that was, I mean, you could not beat that policy. And again, he did that, and a couple things happened in his favor. is he took the policy when the interest rates were much, much higher than they are today. So the guaranteed minimum that this insurance company paid him, they never thought they'd have to pay him that kind of guaranteed minimum. 5.85% on cash value, they never thought it'd be like that. That was cheap money back in the 80s. But it's not cheap money now. It's freaking fantastic now. On top of that, he had the ability to fund, and this is the critical thing with cash value life insurance. If you can fund it heavily on the front end while you're young and in good shape before it really starts to become expensive, cash value life insurance can really mean something. I mean, if you're 30 years, 35, 40 years old, young, and you got excess cash, I tell you, man, there could be a good place for cash value life insurance, because it's completely contingent on your ability to fund it on the front end while the cost is as low as it'll ever be. The thing with cash value life insurance, unlike term, is cash value life insurance, it becomes progressively more and more expensive the older you get. And because that, term is just a flat fee. Term says we're going to basically amortize your fee over 20 years, and after 20 years, it's going to be incredibly expensive, because after in the year 21, it'll be an annual renewable term, which means it's just going to be more and more expensive. So after year 20 or year 30, however long your term policy is, you still have the policy, but by then the premiums will jump so high that the vast majority of people will cancel those policies, because it's incredibly expensive at that point, because it wants to cover you for a term. It's literally, we want this insurance for a term amount of time. That's it. It's wonderful in that regard. After the term is up, though, it's not wonderful, because the fees are so high for life insurance, because you're now 20 or 30 years closer to death, which means it's incredibly expensive at that point. Cash value life insurance, though, it's literally there for your whole life, depending on, even a universal life is there for your whole life. That's the way it's structured. But what happens is they don't know what the fees are going to be. They don't know what the interest rate is going to be, or the performance of your cash value on a universal life policy next year, the year after, the year thereafter. So it's always adjusting. It's always adjusting in terms of fees, simply because the older you get, the closer to death you are, and thus the more the insurance costs. I mean, think about it. If I was 20 years old and in good shape, let's say I'm in Special Forces in the Army or Navy SEAL, all right, $1 million life insurance policy for me is a heck of a lot cheaper than it is for me, 50 years old, old, maybe I smoke in bad shape or something like that. And the reason for that is because I'm closer to death. The 50-year-old guy is closer to death and probably in worse shape than the 20-year-old Navy SEAL. I mean, that just makes sense. So life insurance gets more expensive the older you get. With cash value, it's exactly like that too. The older you get, the more expensive it becomes. And so what happens with cash value, because it's supposed to be there for your whole life, that each and every year it gets more and more expensive the older you get. So now you're 40 years old, and you're 50 years old, and you're 60 years old, and 70 years old. By the time a lot of people have, when they're 60 and 70, they no longer have enough cash to cover the cost of insurance. And so what happens is now you have a depleting cash value component of the life insurance. And so what will happen is, and this is the big con about life insurance, is that the policy will quickly evaporate. There will not be enough cash in which to cover the policy. It's just, you're like on a precipice. You're literally looking down on a cliff, and you're about to fall off, because you developed enough cash value in here, but now the cash value is being eaten away by the fees of the life insurance. And unless you start funneling some serious money in there, that life insurance will expire before you do. Now, if you can fund it like this guy just told you, with a significant amount of cash value in the front end, a lot of times you don't need to ever pay another premium, because now what's happening is you're developing all this cash value that's growing, that's accumulating, that's building and building and building, when the cost of insurance is pretty cheap. And so now you got, like in this case, the guy had $5 million, and again, I don't remember the specifics, I just remember it's freaking insane. A significant amount of cash value in there that's paying out, $250,000 a year. And for him, the cost of insurance was probably $80,000 a year or something like that. So his cost of insurance is low, his cash value is high, and his cash value increase is high. Again, by luck, but also by the fact he was able to fund it significantly on the front end. And so that's a pro. I mean, my goodness, if you can fund a cash value life insurance heavily on the front end, this is why rich people use it, because they have the ability, the resources to fund this puppy on the front end that most regular people don't. If you can fund that puppy on the front end, basically first 10 years with real good assets, the cash value life insurance can be great. The issue is most people can't. And most of them will expire before they do, which means you've wasted all that money. And that's the drawback. And I've seen that happen a million times a Sunday. People thought the life insurance was going to be good to go because they took it out when interest rates are high. And then what happens is interest rates fall off a cliff. And now they're no longer getting a 5.5% rate of return. Now they're getting 2, guaranteed minimum 1.5. And that's not enough to cover the increasing cost of life insurance. And so what happens is now you're 70 years old and you missed out on the opportunity to have invested the rest in the markets, but you put it into the life insurance component, but now the life insurance component, the cash is basically nil. And you'll get a letter from the insurance company that says, oh, to keep this policy afloat, you got to send us more money. And I've seen that happen 10 times, probably 50 times for every time I've seen it happen the other way, where this guy was able to pre-fund his life insurance component significantly with heavy cash value. So unless you have lots of disposable income, I'm just not a fan of cash value life insurance, because I've seen it with my own. Every life insurance agent has. They all have. I'll never forget, I had this guy. He was a friend of mine, and he actually introduced me to the alternative to life insurance, to buy, term, and invest the rest. He used to do these quotes, though. I'll never forget. And he'd show you these illustrations of the amazing success of life insurance. And then, but I'd look at these quotes, I said, but that includes some guy putting in $2,000 a month. The guy's 35 years old. I was like, Dave, who can do that? And he said, well, we got to find the money someplace. I said, but there's no money to find. Now, again, if you're wealthy, I'm telling you, wealthy people should absolutely use cash value life insurance. If you're just regular Joe, like most of us out there, you're not going to have that kind of cash. I'll never forget. That's like, and this guy was a nice guy, but he wasn't shy on letting you know his opinions. And he used to say, when the markets are getting hammered, he goes, oh, let me check my cash value life insurance. Oh, it's not going down. And his argument was, look, cash value life insurance is stable. And I said, I get it if you can fund it on the front end, but you're showing these quotes and these illustrations of some guy putting in $2,000 a month. And most people, and young and particularly with kids, they can't hardly squeeze, $150 together. It looks great on paper, but it never comes to fruition. Life gets in the way. And that's my thing with cash value life insurance. On paper, it looks fantastic. In reality, though, the reality is completely different. Completely different. So unless you got real money that you can contribute and consistently contribute, that's not going away. I don't think you should do it. I'm not a fan of it, just because I've seen it with my own eyes. And it's not just a one-off. The one-off was the guy who made it work real well. The vast majority of the time, it's the exact opposite. And so if you can get a contract with an employer that they're going to put in $20,000 or $50,000 a year into a cash value life insurance, I got no qualm with that at all. None. But if it's just you off your income stream and you're raising a family and you're like, life is good this year because I made some heavy commissions, but next year I'm not so sure, I don't think you should do it. I think you should stay away, because that policy will expire before you do, and then you won't have any life insurance and you'll have no cash value to show for it. Whereas at least if you would have bought term and invest the rest, you would have no life insurance after the term expires, but you would have some cash value. Anyway, hope this helps. It's just my take on the pros and cons of cash value life insurance. Thanks.